Hello dear class, welcome to chapter 12, a video lecture on accruals, deferrals, and the worksheet. This chapter directly relates to what we covered in chapter 5. In chapter 5 we talked about the worksheet and we just covered some of the deferred or prepaid expenses. So we had three types of adjustments. We learned about adjusting entries. Now we're expanding the topic of adjusting entries to include many more types. But you do have to remember what we covered in chapter 5. So please, I will place a link. Please watch chapter 5 to refresh your memory about the adjusting entries and the worksheet. Okay, so in this chapter we're going to talk about different adjusting entries and then very briefly worksheet because you already know how to prepare it. And for adjusting entries, first of all, I will talk about merchandise inventory. And then guys, we will talk about prepaid deferred expenses. Not really going to talk about them because they were all covered in chapter 5. And then we will talk about a new classification or group of adjusting entries called accrued expenses. Then we will cover so-called unearned or deferred revenue. And the last group will be accrued revenue. So we have, besides inventory, because inventory kind of stands on its own, we've got four types of adjusting entries: prepaid expenses, accrued expenses, unearned revenue, accrued revenue. Okay, let's jump into it. So let me talk first of all about adjustment for inventory. Let me actually delete these losses. Let's just focus on inventory for now. Okay. And guys, we have to make this adjustment for inventory because in this class we're using so-called periodic inventory versus perpetual. When you take financial accounting, you will talk there about perpetual inventory. Under perpetual inventory, you will adjust the inventory account every time you make a sale or make a purchase of merchandise. In this course, we studied periodic inventory, where we have an account called inventory in the general ledger. You can see there is $52,000 there. But every time we made a purchase, we directly debited a different account, purchases account. So our inventory account did not change when we bought more inventory. And when we made a sale, we directly credited account called sales, which is a revenue account. We did not took it out of inventory. So right now, at the end of the period, unfortunately, our inventory account represents the old or beginning balance. We have not adjusted it. So we're using the periodic inventory system because we're going to adjust inventory to the reality only once a period, which we're going to do right now. So guys, we do a physical count on inventory on December 31st, and you can see that now inventory instead of 52,000 is actually 47,000. So we have to take out $52,000 and replace it with $47,000. That means we have to make an adjustment in two steps. And for each of the two steps, we will use two accounts: the inventory account or merchandise inventory, same thing, and the income summary. So the first step, we're going to remove beginning inventory from the inventory account and set it off, place it in the temporary account called income summary. We used it in chapter 6. I like to think of that account as a trash can. We throw stuff there that we don't really need anymore. So what's the amount of the first inventory adjustment? It's $52,000. It's the amount of the beginning inventory. So what we're going to do here, we're going to take this 52,000 and offset it, make inventory account into 0. So we're going to credit inventory account, which makes this account 0, right? So inventory account is now 0. And we're going to move it into income summary. So we debit income summary just because we have to place that old amount somewhere. And in chapter 13, we will need to use this amount, beginning amount of inventory, to figure out the income statement. So we will keep it there. and we credit inventory account, which makes its balance go down to zero. The second step, we're gonna place $47,000 ending inventory as a debit to inventory account and as a credit in income summary. What we're gonna do, so as a result, when we prepare our balance sheet, our inventory account now has the correct ending balance. We will keep both amounts in the income summary. We will have the debit balance represents the old inventory and the credit balance represents new inventory. And as I said, in chapter 13, we will need both of those amounts. So this is beginning balance of inventory, debit side, and this is ending balance. And we will need both amounts to calculate cost of goods sold under periodic inventory. Again, if we use perpetual, we don't need to worry about it. We will need to use both amounts to prepare the income statement. Okay, so that finishes our discussion of an adjustment, or I should say two adjusting entries for inventory. Now, before I move forward to other adjustments, I want to point out that what we're using in this class is called the accrual basis of accounting. The accrual basis of accounting. There is a cash basis which we do not use. It's not accepted by GAAP. Accrual basis of accounting goes against our nature sometimes, because what this basis of accounting makes us do, it makes us recognize revenues and expenses without regard to cash. We have to record revenues, income, revenues, sales, not when cash is received, but when it's earned. So as a result, sometimes we receive cash before revenue is earned. We get advance payments. And often we first provide service, which means we earn revenue, but we get paid later. So that's why we have such accounts as accounts receivables under accrual basis of accounting. And this is a rule. This is what GAAP requires. GAAP requires accrual basis of accounting. The same story is with expenses. In expenses, we do not record them as we pay cash. Instead, we ignore cash and we record expenses when they are incurred, take place, used. Sometimes we pay cash first, but the expense happens later, and that would be called prepaid assets. Sometimes we receive a bill for PG&E, and we don't have to pay that amount until later, but we have to recognize expense right away because we already used utilities. And even though it's not due yet, we have to record it as an expense. So these are two very important concepts and descriptions of accrual basis of accounting, and they describe two principles of accounting: the revenue recognition principle as well as the so-called matching principle, or the expenses recognition. And so because of these differences between cash coming in, going out, and actually earning revenues and incurring expenses, we will have with you different adjusting entries that we have to make. Different adjusting entries. So in general, I want to mention this. Adjusting journal entries take place only in the accrual system, accrual accounting system. So as a result, we have two types of adjusting entries. One is called deferrals, fancy words, but they're easy to understand. And another one is called accruals. So these two differences have to do with cash. Under deferrals, cash first exchanges hands. We either pay cash or receive cash first. And now we have to recognize, we have to make an adjusting journal entry to recognize either revenues or expenses that took place. So under deferrals, we pay or receive cash first, and we defer the use of those, we defer the recognition, I should say, of revenues and expenses until later. So based on this, there are two types of deferrals. One is called deferred, Or, same thing, we call them or prepaid expenses. And guys, we covered them in chapter 5. We talked about 3 types. It's adjustments for supplies, adjustment for prepaid expenses such as prepaid insurance, prepaid rent, prepaid advertising, and depreciation. And the second group is called deferred or unearned, same thing, revenues. We haven't talked about them yet. Your textbook does not describe them in much detail. I'll describe them a little bit more. Under accruals, we recognize an adjustment. We make an adjustment first. Right now, we make an adjusting entry for revenues and expenses that took place, that we earned or that we incurred. But cash will be received or paid later. Cash will be paid in the next cycle, in the next period. So we recognize revenue today, but we will receive cash later, such as accounts receivable. They are not mentioned here, but really we recognize revenue now, but we will receive cash later. And expenses, they took place. We have to recognize expenses today, but we will have to pay cash later in the next accounting period. And of course here we will have 2 types of adjusting entry. One is called accrued expenses, and the other one is called accrued revenues. So your textbook covers the expenses first, these 2 expenses first, deferred expenses, accrued expenses, and then it covers deferred revenues and accrued revenues. So I hope it makes sense. If not, make sure you understand and comprehend this information. I'm going to stop here and I will continue with the description of each group of these adjusting entries in the second part of the videos. Thank you so much.